You have to produce a positive expectancy strategy. So you've got to develop a methodology that works, right? And that's probably where you and I spend most of our time. Because once you work out how to trade, the business of trading, it's very prescriptive. It's like joining the dots every morning. It's a job, it's repetitive. There's nothing exciting about just trading, right? What I find enjoyable is trying to reinvent my mousetraps, trying to find a better way to do things. That's the most enjoyable part for me, is the discovery process of developing a sharper knife, so to speak. And how to do that, essentially, and I talk about this in my universal tactics of successful trend trading, about how somebody can go about on developing a strategy. So they've done the audit, they suddenly realize they've been trading with a negative expectancy system, which has given them a risk of return above 0%, that they have to step away from their keyboard, leave their trading account alone, and they've got to start again and develop a positive expectancy strategy. Essentially, you need to get the proper tools available to you, okay? First of all, in my opinion, you need to develop or select a universal portfolio of markets. Two big missteps people make in developing strategies is they data mine and they have excessive curve fitting. So data mining is people will only look at those markets that their ideas work well on, right? They may focus on interest rates or equities or currencies, and they may develop a strategy that does very, very well on those, right? Well, yes, they have, but it may not be as robust as I think they are, because they've only developed it on the markets that look good to them. Even though you may only want to trade currencies, you should develop your strategy on a universal, diversified portfolio, so that you can prove to yourself that what you're developing is robust and is not a function of data mining.
When you see that the juice is starting to come out of that space, and maybe some of the rotation of money away from that trade is moving away, and you're going, okay, I'm going to be wrong on this one soon because the weight of money isn't supporting my idea anymore, then you set what's called a profitable stop. And on a single stop, it's really easy. You pick a good, healthy technical level that's on a certain chart over a year or maybe a 2-year sort of period that you're looking at, and you say, if it drops through here, I'm actually now that's the point. That's the line at which I'm happy to not know about this stock for a while now. And I've done that. I've done that with a lot of things as this market's gone up, and then you have the jitters, similar to what we're having now. We had one last year. Sort of go through these ones, and I set these lines that are down below these key levels, and they very rarely do they get hit. So it's something that's quite interesting. I'm an okay stop setter. There's a credit to myself there. I'll give myself a little pat on the back. But yeah, you set that line, and it's a profitable stop, and clients are happy with that, because no matter what, it does go through that point, and you can still lock in a profit, have some cash waiting for the next one. But you only do that with stuff that you're okay. The only time to do that is when you think that, okay, yeah, the theme or the juice is sort of coming out of it, that the weight of money is moving away from that sort of area.
I think the number one thing that's challenging for most folks is the consistency, and just the basic consistency of showing up every day and being able to trade. I don't trade every single day, but I'm pretty much here most days. And when I got started, I was young. I didn't have a lot of obligations and responsibilities, so I could be there every single day. If you're middle-aged with a family and you're already have a job and you're sort of trying to add trading to your income potential, then set it up in a way so that you can be consistent. Make it only an hour a day in the morning that you're going to watch the markets, but then be consistent and be there every single day. If you look at going back to the athlete analogies, runners and basically all athletes, you don't start training for a marathon by running a marathon. In most cases, you start with little bite-sized chunks. So if you can just go out every single day and follow a kind of a smaller training plan that's going to get you to run that marathon, it's a matter of running the marathon is accumulation of all those small days of doing 1 and 2 mile runs. And I think trading ends up being the same way. If you just look at it as, okay, I want to be trading 20 ES contracts and making $250,000 every single year, it can be overwhelming, and you think, well, where do I even begin? But instead, if you focus on, okay, this week, I really need to focus on just, if I'm in a trade, I leave my stop alone and I break my bad habit of, getting rid of my stop or widening my stop. And then you just kind of go one by one and break some of those habits. And then all of a sudden things start to click. And then that intuition, because you've been in front of the screen for a long period of time, starts to give you maybe you take a trade that ends up being a winner, and you pass on a trade that ends up being a loser, and all of a sudden your P&L starts to become more in favor.
Traders should never risk more than 1 to 2% of their account. And if you're starting out, let's say you have a $5,000 account, sometimes it's hard. Sometimes you might have to risk 3%, but rarely you should do that. You should only risk 1 or 2%. And now that there are micro E-mini contracts in the United States, which is 1/10 the value of an E-mini, you can trade that. Also with Forex markets, you can just trade 5,000 units, 10,000 units instead of 100,000 units or 1 million units. So you can trade very small. And I sometimes hear people tell me, Al, if I trade 1 micro E-mini contract or 10,000 Forex units, I'm never going to get rich. And my answer to that is, when you're starting out, your goal is not to get rich. Your goal is to stop losing money. And you want to be losing as little money as possible. So the first objective is to stop losing money. The second objective is to grow your account. And that might take a year or 2 or 3, but at some point, if you're doing the right thing, you will be making money, and you'll grow your account to the point that you can start to trade 100,000 Forex units, or you can start to trade a single full-size E-mini contract. And if you do that for a few years, all of a sudden you can start, trading, doubling it or tripling it. And at that point, you can start thinking about making a lot of money as a trader. So yeah, everybody wants to get rich, but there's steps involved. And when you start out, you don't want to be losing much money. And the best way to do it is to trade very small. And then your first goal is to stop losing money. Your second goal is to become consistently profitable, and grow your account. And then you start thinking about making significant money.
My philosophy is using a combination of fundamentals and technicals. So technicals will help me identify the trade setup, but fundamentals will drive the trade and help me decide whether I want to actually take the trade itself. Because one of the greatest mistakes I think that a lot of traders make or they believe is that they have a system and they have a strategy. It's going to work 100% of the time. And I think you and I both know, being seasoned market participants, that that's just not true. Nothing can work 100% of the time, right? So, in reality though, what it really means is that by putting an additional layer into it, which is the broader fundamental themes, and making sure we filter out the false signals and we focus on only the trades that are supported by the macro picture, the bigger picture. That's when I find that I have the highest accuracy in terms of my trades. That was what I learned from day one, sitting at the prop trading desk or the market making desk at JP Morgan, and it's still on its most basic level what drives my trades today, 20 years later.
Being profitable in trading is only half the battle. In fact, I would say being profitable in trading is only 20% of the battle. Nobody just wants to be profitable. People want to be consistently profitable. And although I was profitable over the space of a year, I would end the year up money. As I started learning about risk management and the start of 2018, end of 2017, as I started to learn about risk management, I realized that I was now going to have to calculate risk per trade, right? And what that meant is I was no longer winning 10% in a trade or 15% in a trade. I was now winning like 3% in a trade or 4% in a trade. And psychologically, that was very, very difficult for me. And so for a long time, that was a bit of a hurdle, because instead of making, a few £100 per trade, 150, £300, I was now making maybe £50, £100, really scaling down my risk, risking like 0.25%, risking 0.5%, and trying to do it how the professionals do it. Now, I found a happy medium. When I started, I was risking like between 5 and 10%. I dropped to risking like 0.25 to 0.5%. Now I risk about 2%. But there was that time period where I was playing about with the risk, and the results were very frustrating, because although I was winning, I would have these periods where, although I was winning quite a lot, it wasn't, my P&L wasn't increasing massively. And I was very, very focused on P&L, because, when I got into trading, that's what it was all about. It was all about the money. And, that was a very difficult period for me. But as I say, being profitable and being able to make money is only a small percentage of the battle. You want to be able to do it consistently. And what I was finding is I'd have periods where, because the risk was all over the place initially, I'd have periods where I'd make a lot of money, and then I'd spend a month where I'd just absolutely erase everything I'd made over the past 3 months with maybe 10 losses, because the risk was all over the place. So I could have a winning streak of 3 months and make thousands of pounds as a young guy, and then in 1 month blow it all away with a few trades because I wasn't managing that risk. That's where I really got my head back in the books in pursuit of that consistency. And consistency is still something that I am constantly trying to improve.